I've never been so excited about stock opportunity ever since AppLovin that we bought under $400. Now it's going up 50%. SoFi is the next. What's up, homie? This is Howie. I'm a principal AI engineer with a PhD in physics. Welcome back to Howieverse, where investing is driven by data. In this video, we're going to look at SoFi stock. First, we're going to look at the price action. It is picking up momentum. And the second thing that we're going to look at is the business fundamental, which I am very excited about. This is where you need to do your analysis, knowing what you own so that you don't go on panic mode when things don't go your way. Let's get to it. In terms of price action, the stock went up 7.4% on Friday, and it's been picking up a little bit of momentum ever since it dropped to this low over here. So you look at this at $15 level, we have a double bottom. Double bottom is usually happen before the stock picking up momentum and launch to the higher. So you can see there is a resistance over here at around $18 level. Now, what we have here is this $15 horizontal line and also this upsloping trend line here. There is two indicators, this upsloping trend line and also this horizontal line, indicating that the stock might have found bottom at this $15 level. Now, if the stock go back to the $15 level, it is still going to be painful, right? That is a 17% drop if you buy at this level. Now, if you look at from the all-time high, right? From the all-time high, that the stock currently is dropping 44%, right? That is really painful. Now, if we drop to the recent bottom, that is 54% pain over there from the all-time high. However, I don't think the pain is going to go on much longer because the business fundamental of SoFi stock has been really good, has been very performing, right? So in the recent earning, right, the earning actually beat on the EPS and also on the revenue, which is very good. And the next thing that we're gonna look at is the business fundamental analysis. Let's look at that. Here we're looking at SoFi balance sheet right now, and this is an A balance sheet, right? Look at the liquid cash. The cash they have is at $7 billion. Yes, last quarter it has 7.9, so there's a $9 million in cash decline, but they have converted this $9 million into deposit, right? So, and loans. So basically their loans has been going out from $36.5 billion last quarter, not last year. This is last quarter. Now in this quarter is $40.8 billion. That is solid growth in terms of loan, okay? And also the total deposit is up 7%. This is very good in terms of quarter to quarter, right? And in terms of liability and debt, they really don't have that much current liability. It's only sitting at $2.6 billion. And they have liquid cash of $7 billion. They could pay this off really easily. Overall, balance sheet is a score of A. Now we're looking at the business more carefully, which is the income statement. Here we have the interest income that is going up 31% year over year. So quarter last year in 2025 and today in 2026. That is solid 31% growth. In terms of interest expense, it's only go up by 16%. This is a great scaling business for SoFi. As much as they gain more in their income from interest, and they're only spending more of 16%. This is gross margin acceleration from 65% to 69%. Very solid business. One thing that has been concerning for the investor is this decline of 43% because of their technology product. They lost a big customer, which is Chime, where they lost the customer, but they are gaining 13 more new customer. What I see over here is that there is a customer concentration before. Now they have more diversification of the customer. So in a long run, this could be not a problem because this 43% decline in their technology product could be short-lived because they gain more customer and now they have more customer diversification. This is definitely really good for the company. Now, if you look at the technology, R&D is only going up 20%, which is good. That is less than 31% that we look at over here. And also the sales of marketing is a little bit high at 40%, which is not ideal. So overall, this is kind of like in line to the growth of the interest income, where it's at 31%. So not concerning, but it's up there. Now, what is incredible is the net income. The net income has been going of whopping 134%. This is excellent, right? And the thing when I look at SoFi is that the net income is going to only improve from this point because they have so little expenses that they need to worry about. This is a very high margin business. So 134% in continuation of this net income capture is not very it is not very exuberant, right? And if you look at the annual PE is at 35x and the forward PE is at 30. This thing is cheap considering the net income that's growing at 134%. Now, the thing that I really hate is like pimples in my ass is the stock dilution. They're diluting people or the investor at 16%. That is quite high to me. Okay, so what I like to do over here is that I would subtract this 31% with this 16% increase. So overall, this is a B plus income statement because of the income is going up so much. However, I cannot give it an A because this dilution is real and they are going to do it again in the future, more likely because of this historical dilution. Now, on the cash flow statement, this is also very encouraging. They have been deploying their cash into working for them. You look at this minus $2.6 billion. This is essentially they are capturing new future revenue in terms of loan, right? So they give out loan to other people so that they can take in their interest. So this is definitely really good, and they have been deploying their cash very intelligently. And if we look further downside, look at this net deposit. This net deposit is going up 105% from last year, 2025, now 2026. This is really good in terms of capturing new customer, capturing new money, right? So basically, in terms of net deposit minus loan buildup, they have $400 million of excess. This is actually a very great cash flow statement and it's pointing towards self-funding. Now, what do I mean by self-funding, right? So the self-funding over here is just telling the investor that, hey, we can eventually stop diluting because they are raising money from the investor by diluting all of us to essentially make their business better. But for the future of the company, we do not want that. We do not want to get diluted. We want it to be self-funding from the operation itself, and that is eventually where they're going to go. So it's definitely pointing in that direction. Overall, this is a B plus cash flow statement. I would like to see they have more surplus in cash. Now, this is my bull case, right? My bull case is extremely conservative. Let me tell you why. So the target over here is at $36. From the price, the stock price right now, that is 2x. Okay. And why this is conservative is because of the dilution. The dilution itself, when you see earlier, it was 16%. I'm just asking, SoFi, hey, stop diluting us that much. Maybe you can go down to 5%, which I think this is very achievable, because that when they diluting the investor at 16%, the stock is high at $30 per share. So when the stock is at all-time high, that is when they're diluting their shareholders. Now the stock is close to $16. Maybe they don't want to dilute as much because they cannot get more money, right? However, maybe in the future it can pick up, but at 5% dilution is extremely achievable. And that is all I'm asking. Just stop diluting and just operate the business, because the business right now, the CAGR is at 38%. So this revenue growth is just telling SoFi, like, just operate like you normally do, right? This is a historical and also projected by Wall Street at 38%. This is just the normal business case for SoFi. And it's the same with the EPS. This is normal. However, I'm asking a little bit of momentum over here, right? So the current pack of SoFi is at about one, like under one, right? Maybe 0.9. So I'm just asking a little bit of pack over here at 1.5, which reached to the price target of 36. Again, this bull case is very conservative, and it's definitely doable if they just operate the business like usual and stop diluting us, and also a little bit of momentum. Okay, now on the base case, yeah, this is not too much as well. It's just basically saying, yeah, you can dilute us like you always do at 16%, right? And also the revenue growth is a little bit of declining, the same as the EPS. I already subtract the EPS from the dilution. So at 54%, where we saw at 103%, 54% is not that much. This is basically in line with the management projection. So I kind of discounted a little bit, where at the trailing 12-month PE at 38, and also at the current pack ratio, the target itself for the base case is already $21. So $18 is definitely cheap right now. And the thing is that for me, this is not financial advice. As long as the stock is below $21, is a buy loading the boat for me. Okay. Now on the bear case, I do have the floor for this stock. So the way I analyze this is based on the price to book ratio. So when price to book ratio is about 1, that means we have a recession or the stagflation in the macroeconomy. So the bear case for me, the target is at $9.5 to $10.5. So that is definitely something that needs to be considered. However, I don't see any recession or stagflation coming anytime soon. So the price to book ratio of SoFi right now is 2, right? So if I divide that by half, that's roughly about $9 or something like that. So I don't see anywhere that is going to go to the bear case at $9. Mind you, when the price to book ratio that is less than 1, that means the SoFi is going for bankruptcy. They're selling SoFi for parts, right? So this is definitely the floor for me. The bear case is not going to go below $9.50. In conclusion, the bull case that I presented earlier at $36 per share is definitely something not too far-fetched because it's very achievable and not asking too much from the company, right? And the thing with the bull case, I see about 35% of likelihood is going to happen, where my base case is only 55%, and I leave the rest on the bear case, which is very unlikely. So the bear case is like about 5% of the chance of we're getting a recession or a stagflation. So definitely bull case has a more upside here, in my opinion. But this is just my opinion, not financial advice. You have to do your own analysis. So let me know in the comment what you find in the analysis, and please hit the like button if you found this video helpful. It will mean a lot to the channel. Consider subscribing if you like more analysis like this in the future. I'll see you in the next one.